20% of the world's oil flows through one narrow shipping lane, the Strait of Hormuz. Right now, that lane is effectively frozen by war risk, insurance withdrawals, and military threats. Uh, that's why oil prices remain elevated because the market has no idea how long that choke point stays closed. So, how does this play out for oil prices in the short term? Good morning. I'm Patrick here. Welcome to the macro outlook for today. Every day, the goal is the same to spot some trends early, make better decisions, and stay aligned with the risks. I'm here Monday through Thursday at 9:30 a.m. Eastern. Okay, so let's dive into this. So I want to just specifically tune into oil and energy stocks. And there's actually one important point that I want to conclude in this. Now, first of all, uh, oil prices remain elevated. We're at near $75 a barrel, and at levels very similar to where we were when the nuclear facilities were struck back in the summer of last year. And so we more or less have approached that. The difference is during those nuclear strikes back in June and July, they didn't shut the Strait of Hormuz down. And here they have. And so now oil did come off about the same level on the downside. Point being here, the less clarity that comes in the weeks to come, and more indication that this is going to be a prolonged escalation. When I put this on a weekly chart, it's not out of the realm of impossibility for us to see us get up to even the 90 plus dollar range on the upside of crude oil under the right circumstances. So is it an easy trade? Is it just, hey, let's just go long crude oil is going to 90, right? Well, it's not that easy. First of all, getting any convexity in this trade is very challenging. You can see here this morning, we were at a 75% implied volatility on crude oil. What is that? Well, volatility is a measure of how much option premium is being charged on speculators speculating on a direction of oil. I mean, we have seen spikes in crude oil volatility go higher, particularly during the crash of 2020 during COVID. But this is a pretty elevated level where buying optionality is not cheap. And so we have very rich volatility premiums in there. So you basically at this moment most naturally would be taking in with Delta One risk, which is you're going to literally go long crude oil futures or an ETF that tracks it like the USO. The tricky part here is at this stage, the asymmetry is actually, I would consider, relatively neutral. Why? Because even if you can make $10 further on the upside of an appreciation, the moment there is any clarity that that the strait will be reopened and be able to be held, then almost certainly oil's war premium will be pulled out, and we could easily revert 10 $15 on the downside. Now, while I actually am quite optimistic and constructive about the long term prices of oil from here, right now, this is really a headline driven market. And I would say even a 20% swing higher or lower from here is going to be purely headline driven without there being any long term fundamentals in its consideration. This makes it rather challenging on the short term from that perspective. Obviously, those of you that have been long crude oil in the last month, because we've talked about this repetitively in January and talking about the bullishness of the situation, those of you that have been long crude oil certainly can hold some outlier positions to speculate on one more little surge higher on the upside that sees another $5+ on there. So the one thing that I want to really though talk about is the fact that it's not going to take till the end of the war for oil to pull that risk premium out. What do I mean? Well, for instance, there was almost no clarity there was almost no clarity on whether or not the escalation in with Iran and the nuclear sites back in June over, and yet oil already dropped from $78 all the way down to $64, literally within 24-hour window. That kind of a risk premium can be pulled out in the snap of a finger. And another great example of that is the Iraqi war, Kuwait wars. You had a scenario where oil was substantially rallying in anticipation of the war. And the moment there were boots on the ground and the military operation began, it marked the top and oil began to correct. Another great example is Russia during the Ukraine confrontation. Oil was rising in anticipation of the in the inevitable attack. I'll give an example right over here. And what you can observe is that oil was ripping from a December low in 2021 of $66 and ripped to a high of about $130 on the upside during that period. But it was only when the military operation began that suddenly oil basically go from $130 down to $90 and essentially mark a top that has actually still been the top to this day. The point here is that the fact that this military confrontation underway, you cannot fool yourself into believing that just because this early speculation is that this is going to be a 4 to 5 week operation, and that therefore oil will hold up for 4 to 5 weeks. That's not going to be the case. The moment the market sees the light at the end of the tunnel, as soon as the market sees that this is de-escalating and the Strait of Hormuz will be able to be controlled and opened, the market will pull $10 out of crude oil faster than you can snap your fingers. And so this is where you have to tread the waters very, very carefully. Now, I want to highlight one quick thing. When you go to the actual energy stocks, what impact does it have on this? Well, I want to highlight that most of these companies are being priced on their long-term earnings potential and the bigger trends of crude oil in the years to come. And there is very little risk premium being arguably given to crude oil because oil suddenly is up $10 a barrel over the last a few weeks or days. The way I look at this here is the risk is not the same on energy stocks. So while there is definitely risk in crude oil positions, the risk is not the same in energy. But energy has been the centerpiece of the sector rotation story, and a huge benefactor of the selling in the mag sevens has been flowing into these sectors, and particularly energy was one of the big benefactors. Energy is overdue for a typical mean reverting retracement, and that the most typical and easiest way to anticipate is a retest of a 50-day moving average, which now lies, let's say, at $51 on the XLE. At any one time, we could see a 10% correction, and I don't think it will be Iran driven, even though maybe the oil reverting may actually just trigger a correction that needed to happen anyway. Overall, I don't think being shaken out of long-term energy stocks is worth it. You just have to be able to endure some volatility. The way I would put it is you want to be actively profit taking some oil on the upside here, but you should probably just hedge up your energy positions without actually selling them. I think that's the easiest way to approach it right in here. Just remember, this oil premium will be pulled out long before the war is over. And as soon as that market has any clarity on this happening, you'll see that move happen, and it will be a $5 to $10 move faster than you can snap your fingers. Anyway, that's where I'm going to end this portion here, public portion here, and end up and go to big picture trading, where I'll be trading with my members. I'm going to be taking a deep dive today into breakout trading. We're actually going to be looking at different individual stock names that we're just going to be looking at whether short selling and or profiting or buying for an upside move that usually is in the kind of 1 month time horizon. So we're looking for more swing trade opportunities and long-term positions there. So we have some great stock ideas there, and we're going to be actually showing how we're putting on the trades in that live where's the trade session. So if you'd like to access, you can start a 14-day free trial. You can click on the link in the chat or go directly to our website, bigpicturetrading.com. Once you're in, you can click that big orange button on the main homepage that says join now, and we'll be live on that webinar in about 5 minutes time. Otherwise, I'll see the rest of you at 9:30 a.m. Eastern time tomorrow for another update. Thanks, everybody.